Okay, so the whole idea of having this meeting today is I want to go through some of these points, and then we'll have uh, Q&A. You can ask questions. You can put them on the chat, or you can ask the questions uh, by unmuting yourselves. So just let me share my screen and tell me if you are not able to see it. Okay. Okay, I don't know if I put it on full screen, what happens. Let me just see if I put it on full screen. Okay. I am assuming if I put it on full screen, if people are waiting on the lobby, it'll pop up. Or let's see. Okay. So the whole idea is that, the entire year we've spent 2022, markets have been pretty much uh, hovering around the same level. So we started the year close to around the 17,000, 18,000 kind of levels. Okay, so I'm hoping, yeah, meeting is in, recording is happening. So we started the year around these levels. The entire year we've not moved at all practically, and you can see this chart, right? We've had most part of the year it's been sort of bearish. We've had longer periods when markets have fallen, then uh, in sort of recouped its losses, fell again, and that has been the story for the entire year. And the interesting part is that India has by far been an outperformer across the globe. Uh, and this is not only in terms of stock market performance, although this chart is related to the stock market, but even in terms of the economy, I think India has been a stellar outperformer. Whereas, across the world, things have been extremely bad. The largest markets like US, Germany, Japan, France, UK, everything has been down. In fact, if you look at the MSCI emerging markets, that has fallen 22% in this calendar year, whereas Indian markets, especially when I talk about Indian markets here, I'm specifically talking about Nifty. Nifty has held up. Now, if I do a slightly deeper look into uh, say the broader market, say a Nifty 500, then the picture is slightly different, but not too much different, right? It's not 20% down in the year. What has happened is the last 3 days of last week, right? Markets were brutal. The fell off was very sharp, decent volumes, and the advanced decline ratio was uh, very, very, uh, you know, very, very shallow, in the sense that there were hardly any stocks which were advancing across the board. So the it looked like there was a very, very strong sell-off, panic, in fact, kind of situation. It happens probably because of multiple reasons. It could happen because there is a uh, in a bull market, these kinds of short, sharp corrections are there, and sometimes at the beginning of a bear market, also you could see a very sharp kind of correction. Now, in my sense is that we are neither in a bull market nor in a bear market. We are just seeing these kinds of whipsaws. So we will see very sharp falls, we'll see very sharp up moves, which actually we saw. If you look at the last bar, this is, I think, on Monday and Tuesday, we saw very, very sharp moves. Uh, if you see what has happened in the mid and small caps, mid and small cap actually fell much sharper, right? And this is not the first time. If you look at the earlier circle that I've made here, earlier in the year also we had, we've seen 2 days or 3 days where the market just sort of tanked completely, and then it went sideways for a while, then moved up and slowly inched up for the rest of the year, and then again it the last 3 days of the last week again the market collapsed. And interestingly, we see that the 200-day moving average, and this is the Nifty mid cap index, the 200-day moving average actually providing a decent amount of support from which it started moving up. So this is the broad context of what happened in the year, what is happening now. Uh, so just wanted to jot down a few points on what lies in store for us in 2023. So first, I think what we are seeing at the fundamental level across the country. So one is we're seeing very strong credit growth picking up, right? So in fact, today's uh, data, this is today's data, that credit growth of banks is at 10-year high. So that's something which is very, very encouraging. Then we are seeing a very strong government capex that is happening, and practically the coming year is going to be the pre-election year budget. So that I'm expecting it to be pro-growth, right? And especially in areas which are visible to the electorate. So it could be roads, it could be railways, airports, basic infrastructure. Then that plus additional social sector spending, which is going to sort of impact the electorate. Again, government capex 18-year high, 2.5% of GDP that has been recorded. So very, very strong uh, growth impetus that is coming up. The third part which I'm seeing is the private capex, right? So PLI schemes that has been given across the different industries, that is leading to a lot of private capex happening. You must have seen that India's current account deficit, especially for the electronics industry, has reduced dramatically over the last 7-8 months, because a lot of new manufacturing capacity has come on stream over the last year, and things are looking better. And structurally, it looks like that the next 4 or 5 years, things will get much better. One part of private capex is, I was just again reading that the Tata Group, the Ambani Group, and the Adani Group, these three alone are planning a $215 billion investment in India in the next 5 years. So, mammoth amount of private capex is going to come in the next 2 to 3 years. Uh, in addition to our regular sectors, the ones which are seeing most amount of investment is what I call the transition sectors. So sectors where things are changing or where things are in transition. So it could be energy, where we are moving from fossil fuels to renewables, including green energy. It could be EVs. It could be 5G rollout. It could be the tech and digital rollout across the board. Right. So these are areas where the transition sectors where we are seeing, or where we are going to see a lot of investments coming through. Uh, the next one is obviously realignment of global supply chains. I practically read an article a day where people talk about supply chains getting reorganized, friend shoring happening, China plus one, Europe plus one. So all of these things are going to play out. The fact is that these things will take a very long period. So China became the factory of the world. It took 20-25 years for it to happen, and it's not going to change overnight. Capacities need to be built in other locations. So it will take at least 5 to 10 years for this theme to play out. But this is a definite this is a definite happening. It's not, there's no going away or running away from this. From a macro perspective, my personal take is we've seen the peak of inflation. We are going to see a stabilization of interest rates, especially in the US, in our other larger economies. I think, especially where there's a lot of debt at the government level. No matter what the central banks say, there will be an inherent interest in keeping slightly higher interest rates and slightly higher inflation, because that is the only way they can sort of get the debt burden down over a period of time. Now, having said that, inflation, in my opinion, is not going to cool off that easily. It's going to remain, especially in India, where most inflation is related to food, right? Food and fuel. Fuel is a complete, something that we completely are not aware of how it will play out. Uh, Even if you take a plus minus 20-25% fluctuation, uh, the other thing, the bigger component is food, and in India, inherently food inflation has been high for, I think, probably the last 10-15 years, and I don't see that changing anytime soon. Uh, the other important factor, and I think the last time we had a webinar, I mean, not the last one where we talked about railways, but the general one we had earlier, I talked about China being a good investment opportunity, and probably since then China has been doing well. And I think now, whatever little I study of geopolitics and uh, markets, I think China is opening up. What she had to do in terms of getting power for the third term, that's all done and dusted. So I think China is now going to slowly go back into the growth mode. What that implies for global markets, commodities especially, is something that we need to keep an eye out for. The last slide that I wanted to leave you with is, so what should we do, right? And what are the things that we need to avoid? So first of all, my sense is at least the first half of next year is going to be similar to the year that we had. It's going to be choppy. We will not have a very decisive trend uh, in terms of either the economy or the markets. Uh, Probably the direction of the budget might lead to some uh, you know, some direction of trend, but that's something that we need to look at. So for long term investors, it's just we will continue to keep reshuffling our portfolio based on which stocks and which sectors look good from an earnings perspective for the next 1 to 3 years. And for our opportunistic portfolios like HitPix and Quant and Quiver, what we'll try to do, and what we always try to do, is we will align our strategies to how the market is behaving at that point in time. Uh, so again, domestic consumption, capex oriented plays are likely to perform better. So that's one universe where we will be keeping an eye out for. And personally, for me, I think I am personally very bullish over the next 2 to 3 years. I think a lot of capex augurs very well for a country like India. And there's a lot of noise right now in terms of the economy, in terms of global recession. XYZ is going to happen somewhere else. If you just blinker out all of those noises and focus on keeping on adding monthly to your portfolio, right? So what happens is that the market may be choppy, and if you keep adding, so every month your portfolio, you add more capital to your portfolio over the next 2 to 3 years. Once there is a decisive trend, you will have much more capital uh, invested in the markets, which will help you actually get better returns. So that's the approach that I would take. Now I don't think is really the time to be afraid. Markets will give you a sharp moves on either side. And personally, I think it's a time to ignore the noise and keep silently accumulating stocks. So I think that's all I had to quickly share. Hitesh bhai, any thoughts from your side on how uh, the year ahead is going to look like? What are your thoughts? What should people do?
Basically, it's a tough call. It's like crystal ball gazing. So, but my guess is we have seen the worst in terms of volatility. We have had almost, say, last October 2021 to this year, October 2022, of uh, very high volatility. Means you have had three or four major rallies and major corrections within a span of, say, 12 months, 13 months. So this kind of thing cannot go on forever. I think my market should establish some kind of a direction, probably on the way up pretty soon. And in that aspect, I think last week's correction was the first shake-off that we saw, because any rally that has to sustain the weaker hands have to be shaken out. And in general, if you ask me, where do the weaker hands invest in the market, then the obvious answer is small and mid caps. So probably last week's shakeout was to shake out the last of the fancy hitters who had joined in late into the rally. My guess is we should start seeing some signs of strong rallies going ahead. But then it's anybody's guess where it will go. But my gut feel is it is going to be a stock pickers market more than before, and not everything is going to move. Very specific stocks with very specific triggers will do well. Uh, Broad-based rallies, I think we may not see. We have had sectoral rallies off and on in the past where, say, fancy changes every month, 2 months, 3 months, one or the other sector starts taking center stage. That might not be the case going ahead also. But my guess is small and mid caps probably will do quite well, because they have been under the radar for a long period of time now. So it's about time they make a comeback. And we'll try to pick out the best from that lot in our picks.
Right.
So that's about it, I think.
Right. And I think, the point that Hitesh bhai made about sector rotation, I think personally, last, I think 1.5 months, the sector rotation had become very fast. Right. So there was like every sector coming and going in, a couple of days. Now that is something which is very unnatural, which means that there's a lot of speculation, there's a lot of, I don't know how to exactly put it, but there's a lot of froth in that way it is being done. Usually, if you have a sectoral play, the trend should be at least for a few weeks to a few months. If you have a sector which is going up and it peters off within, say, 1 week, then there's a challenge. So and that's what I was observing. That 1 week paper did well, the next week cement did well, the third week something else did well, and every sector that was doing well, after 1 or 2 weeks it was sort of mean reverting back to where it started off from. So that's something which was very interesting to observe, but something which made me feel that probably we are getting slightly exuberant. But again, overall, I think the structure of the market looks quite interesting. I personally feel a
And
lot
on
of stocks are doing well.
the
Ah,
subject of structure that Abhishek is mentioning, it actually, if you see the technical charts of the market since ever since the last correction began in October 2021, we have had an expanding triangle kind of pattern. Basically, it's exactly opposite to a symmetrical triangle. That is a contracting triangle. In contracting triangle, what happens is that the volatility and prices tend to compress over a period of time, and then there is a breakout. Here, what has happened is there was this expanding triangle. The falls and rallies were getting larger and larger till the last one, and then we probably have broken out on the upside. Going ahead, there might be some base formation, and I think this expanding volatility period probably might have been over. So we might see some kind of definite trend emerging. I think is a basic uh, inference from the breakout of the expanding triangle chart that we have seen on the index. It
Right,
plays out needs to be seen, but let's see.
right, right.
Go ahead, Abhishek.
Okay, so let me open up, the for questions. So if you have any questions, you can put it on the chat box, and we'll start doing it. And okay, the first one will be this first question is from Urmil. So what will be your thought on SIP, since you've mentioned we may reshuffle this one already? To add on, Gujarat related party was over, management was demonstrated that they're clearing in. Okay, okay. So yeah, so first of all, I don't want to get into a lot of stock specific discussion here, because the two reasons why. You might have seen this earlier as well, that I don't get into a lot of stock specific discussion usually, and the reason is because that most of the time, if I speak a lot about a stock, it sort of has that commitment and consistency bias. So tomorrow, if you have to get out of that stock, it will always be there at the somewhere at the back of your mind, saying that I spoke good about that, or conversely, I spoke bad about that, and then I have to buy it again, or I have to sell it now, etc. So that is one part. But first of all, when you are doing a SIP, okay, let's look at the structure of a SIP. Whether you are investing in the long term portfolio, or hit peaks, or quant, or quiver, whichever way it is, it's ultimately a set of stocks. So your objective in doing a SIP is to put money into that basket. Okay, whatever is the constituent of that basket, and as long and the constituents may change. Today we have, say, stock A. Tomorrow that stock A may get replaced with stock X, but the constituent of the basket may change, but your objective is to put money in that entire basket, right? So that is the whole concept of doing an SIP. And the reason I'm stressing on doing an SIP is that most of the time what happens is, when markets don't go anywhere, people don't keep investing, and especially in individual stock portfolios, it's easier because to do in a mutual fund, because it's all automated, right? But when it's your own stock portfolio, what sometimes happens is, we don't keep adding money every month from our salaries or business income or whatever, right? So what I wanted to just explain, or or highlight is, next 6 months, 1 year is a good opportunity for us to actually put uh, money into the stocks. Okay. I think again, let me see. So all the stocks that we have in each of our baskets, so whether it's long term, hit picks, again, as I explained, so long term, because of its nature, has a slightly longer term orientation. All the stocks that are there, we can keep adding to them. Okay. Uh, what we will do, you know, once in a while, is we will keep updating our the stocks that might go into that portfolio. But the point is that it will not be a dramatic change. It will not be like 10 stocks will go out, and 10 others will come in. So it's not going to be that dramatic. So the most important part is to continue to uh, keep adding. Okay, the other important thing is, so I think there are a few questions on Gujarat Fluoro, etc., because it has seen a lot of fall. I think Hitesh Bhai is very, very positive. So am I. I think it's a company where they are doing the right things. The management has been, the management has not, there are, there's a history to the company, to the management, that needs to be cleaned up. The management, in their recent interactions, are saying that that's what they are doing. Uh, but the news flow, the result that are expected, or the results that are coming, that they're delivering, is actually quite good. So I don't see any reason why we should not continue to add, Gujarat Fluoro, as long as we are within the limits of the recommended allocation. Okay, similarly, somebody is asking about Garware, exactly the same answer. The point is that it doesn't mean that tomorrow we will not switch away from Garware to something else. We can, but it's just a matter that if as and when we switch, you have to sell that position and get into the newer one. So the whole objective of moving from one to the other is, obviously, when we are selling something and getting into something else, uh, the idea is that we will be able to get better returns from the newer one compared to what the one we are holding. Okay. So the next question is from Yogesh. What's your view on rising interest rates and people moving to debt funds from equity funds, and overall its impact on market valuation? So I think people are really going to be, they're going to be stupid if they are going to do that right away. Interest rates have not completely sort of peaked, and they're not going to fall. So you're not going to make a lot of money if you have. Uh, in any case, right? I mean, what will you get in a debt fund is basically 7-8%, uh, and the benefit of getting into a debt fund is when you are in a declining interest rate scenario. So when you're in a declining interest rate scenario, you actually make capital gains, right? Because your yields go up, and that is where you make money. I don't see that happening, at least in the next 6 months to a year. Uh, I don't know about a year, but definitely not in the next 6 months. Uh, I don't see a lot of liquidity moving from equity markets to debt. Typically, in Indian markets, I think the debt markets are not that evolved. People put their money in fixed deposits, but personally, I think that crowd is different. So somebody who's a fixed deposit investor is not going to take money and put a lot of it into equities, and vice versa, right? I mean, if interest rates go from 6 to 8%, I will not take a lot of money out and put my money into debt funds, or into fixed deposits. So I will not bother too much about debt funds and how it will impact the markets. In fact, on the other hand, what I see is there is a huge amount of money flowing in from the provident fund organization, from insurance companies. So the DII fund flow is getting is strong, and it is getting stronger. So that's a major benefit for a market like India. So the next question is Shiva Kumar. Which of the long-term portfolio stock recommendations we can continue to sip? All of them. Okay. Next question is Darshan, from Darshan. What's your view on PSU sector from long-term portfolio perspective? Has shown good traction current year. Considering pre-budget year, they may continue to benefit. So first of all, I think I don't like PSUs. I've mentioned that multiple times before. There is an inherent problem with PSUs because of because I don't like the promoter. I don't like the government of India and the ministers and the bureaucrats running businesses. Inherently, it leads to lower return of capital, lower efficiencies, etc. So uh, I think the benefit of a lot of PSUs sectors. I mean, PSU as a basket, I don't find that interesting. But if there are individual companies where previously we've had rights in our portfolio, so individual companies, wherever there is an opportunity, we'll definitely look at it. But in general, if I find two companies, one is in the private sector and one is a PSU, and more or less other things are equal. I would always tend to go with the private player, because simple thing is interests are more aligned to shareholders. The promoter is more willing to sort of maximize earnings and growth. Okay. Next question is from Rahil. How do you see the current market in terms of finding new stocks and themes? Is it difficult to spot new business stocks for the next 1 to 3 years? I think it's not difficult. I think themes are pretty evident. I've been talking about the themes for the last 1 year. Uh, Engineering, capital goods, in infrastructure, uh, most of the stuff which is real estate, all of those things which are consumer focused, capex plays look interesting. The problem is to get good companies with good growth prospects at reasonable valuations. That's where the challenge is, and that is where we need to sort of keep juggling from one to the other, right? Otherwise, most of the companies that we hold, if you see whether in the long term or in hit picks or in the other portfolios, all of them are reasonably good. But the problem is, relative valuations, relative growth. That's the thing that we need to juggle. The next question is from Kanchana. This question is for Hitesh Bhai. Okay. So Hitesh Bhai, question for you. On the weekly charts, weekly Nifty charts, I see an inverted head and shoulders, which is very bullish. But I also see that it has failed with recent fall after giving a false breakout. What is your take on this? Also, this is the. I think if you're looking at my screen, I don't know if my screen is visible. I think this is the one that she's referring to.
Yeah, so basically, I answered that in the chat box,
Okay.
and I cannot share my chart on this. How do I do that?
1 second.
Snip करके where do I put it?
No, you don't snip it. Now, you share your screen. 1 second. Let me see if I have to unshare. Uh, 1 second.
ये रहा share है ना?
हाँ, आप शेयर कर दो.
What do you want to share? How do I put a chart here? Can I?
आप वो you share your screen. उसमें आ जाओ.
Okay, एक मिनट. स्क्रीन में शेयर करता हूँ. Share. So this is the thing I want to share. Can you see that?
Not yet.
This GMMA chart of Nifty. Can you see this on the
No,
screen?
at least I am not able to see. Others see?
No, no.
No, I am.
No.
So then there's a problem.
Okay, मैं देखता हूँ.
Is there a way where I can share a chart in this thing?
एक मिनट, मैं आपको co-host बना देता हूँ. Let's see. अभी शेयर करिए. Just share it now. You see. नहीं तो अच्छा, आपका GMA तो मेरे पास नहीं होगा. हाँ, को क्या हो गया? प्रतीक इज
ये
शेयर.
मेरा स्क्रीन है. आई जस्ट ट्राइड समथिंग तो होता है.
तो
किसमें
हटाओ.
किया आपने? How do I do that?
नहीं नहीं, हितेश भाई आप नॉर्मली शेयर करो, आ जाना चाहिए अभी.
आई हैव जॉइंड विद मोबाइल. इसमें तो ऑप्शन है तो इट शुड
नहीं
बी ऑन
नहीं,
द
शेयर का
डेस्कटॉप.
ऑप्शन तो उनको भी दिख रहा है.
हाँ.
अच्छा,
Yeah.
दिस इज द.
Yeah, so basically ये जो whatever you are seeing exact accurate नहीं आएगा, but you can see this inverted head and shoulder that Abhishek has put up.
या
थोड़ा
दिस वन.
line थोड़ा different होगा इसमें,
हाँ,
but you can see that 17,800 was the main breakout point of this inverted head and shoulder,
दिस वन.
and that was the level that got tested exactly last week, and from there it has reversed. You see that?
या
So basically, the pattern is still alive. Whether it kicks or not, we have to see. My gut feel is the way people are nervous and everybody is scared. So there are very high chances of this pattern playing out, and maybe we might see levels of 19,500 to 20,000 kind of levels over next several weeks.
Wonderful, wonderful. That is
That is
great.
at least what the charts are saying. How it plays out, that we need to see.
Okay, then let me see where the chat is.
Now we can go ahead with other questions. I think this chart also is sufficient enough.
So let me see the chart. Chat. Yeah. Okay. So okay, 1 second. Okay, just give me 1 second. Let me mute everyone. There's some.
I think one key message that everybody should know about is to avoid sectors that are in decline. So basically, technology, chemicals, these are the kind of sectors we want to avoid, even the bulk pharma kind of guys. There has been a short rally last week in this API space, but that was not very convincing. Probably that was a chance to exit if you are holding it. Better avoid sectors which are now out of favor of the market, because whenever market corrects, these are going to be the hit the most. And the next question is, where do the odds lie? So we have been sharing off and on. I think financials, defense, select PSUs. Um, I'm talking about the opportunistic kind of thing. So if you want to play next 1 to 3 months, maybe 6 months, then that could be the plan. But most structural rally seems to be in the financial space. Go
Okay.
ahead, Abhishek.
Yeah. Okay. So the next question is from Manish. Given the backdrop of global recession, what's your views on IT sector? Should one start building large position now, or a 12-month sip in few stocks is better? First of all, I'm not very keen on IT sector right now. I think in the last week when I was on ET Now, the anchor asked me the same question. I think the problem with IT right now is that uh, demand is extremely weak. Demand is not going to change overnight unless the sentiment changes. And IT services companies are that the management commentary has always been very, very how would I put it, misleading, right? Either they mislead themselves and always remain hopeful and cheerful. But the fact is that when Europe and US are uh, in financial troubles, the first thing that gets cut is the IT budget, especially new implementation, etc. So it's IT is going to be in a tough spot for the next 6 months to a year, in my opinion. So there's no hurry in terms of getting into IT sector. We need to pick and choose differentiated companies. So companies like say a Tata Elxsi or a KPIT or maybe LTTS kind of a company. Those or persistent. So somebody who has slightly differentiated, maybe slightly orientation towards products, etc., could be better bets compared to vanilla IT services companies. Okay. Okay, so there is this very interesting, sort of problem that Shiva Kumar is asking about. So he's saying why I'm asking about SIP is because I added Loras at 660 as I had some good money, but at 640 exit was mentioned and I finally sold at 540. Okay, that's why please suggest which stock should be continued with SIP. Okay, so very interesting problem, and this is a very practical thing, right? So I am asking you to, let's say there are 20 stocks in the long term, and I'm saying that you go ahead and buy all of them, and maybe it's just possible that uh, say in next 1 week, 2 weeks, 3 weeks, 1 month, I will say that okay, say company X we will sell and we will replace that with Y. And what happens if you if you put in a fair bit of money now in X? Now, let's take this example of Laurus. So, irrespective of what and how much amount of money you've put in at Laurus at 660, if I am asking you to sell at 640, you sell at 640. It's as simple. There's no question in my mind as to what should be the course of action. There should be no price anchoring at all. If I've bought at 660 and the price today is 640 and I get a sell recommendation, I sell. Right? And then with whatever, I replace that, I think, with Elicon. So if I sell at 640 and I put that money in Elicon has gone up more than 100% if I remember correctly, or 70, 80%, 100%, 120, whatever slips my mind. The point is that, and even if you had not bought Elicon, if you bought something else, right, all the other recommendations, point is that it absolutely makes no difference. The idea is not to, when you are sipping, you're not putting all your savings or all your incremental savings in one stock. You're distributing it in all the stocks, or as many as possible. So let's say you want to put in, say, 5,000 rupees this month or in January. And with 5,000 rupees, you cannot add all the 20 stocks or all the 18, 19 stocks that are there. What are you supposed to do? There are multiple ways. To me, always simplicity is the best. Just, order them in terms of whichever is either, the cheapest in terms of price, or just do a alphabetical order. Buy the top 5 that month, the following month buy the next 5, the third month buy the next 5, and so on and so forth. In the interim, if something changes, just make that change. Don't get stuck with a particular name and with a particular price. That, okay, I bought XYZ, Laurus Lab at 660, so I cannot sell it at 640. That logic is something. The moment you get anchored to a particular price and you get loss aversion actually is one of the biggest problems in the equity markets, and which actually, in my opinion, leads to the most amount of loss. The fact that if you are not able to take small losses means that you will eventually take large losses. Okay, so I hope I've answered this question, because this is an important question. So, views on Divi's and Alchem. I personally, I think I like Divi's, although next couple of quarters looks to be slightly flattish, I would say. Alchem, again, good company going through slightly tough times, right? So we'll have to see what we do. I mean, if we have better relative performers, then we might have to switch out of Alchem and see how things go. Divi's is something that, again, I think the runway and the is fairly long. The quality of the company is very high, so might want to persist a little bit longer with Divi's. Okay. Next question is from Nirvana. What is your view on infrastructure sector in the next 1 to 3 years? Although government capex via NIP and Gati Shakti are high, NIHI contract value is slow. Railway capex has also been slow this year. So yeah, I mean, this is par for the course. It has always been the case that order, government always plans, say, for 100 rupees, and finally orders will go out for 80 and execution will happen for 60. So it's foolish to expect that if somebody has a commitment of 100 rupees, or if the government is telling you that they've budgeted, or if they've committed 100 rupees, that 100 rupees is going to happen. You should plan and think about between 50 to 60% of that is going to come through. Now, in the infrastructure space, 50 to 60% of what the committed value is also significantly large. From Girish, what is your view on India Bulls real estate? I don't have a view. It's not in a very good shape right now. We'll see, and as long as as and when the merger happens and things go through properly, we evaluate. I don't personally think that Embassy Group is uh, far better than what India Bulls was. Although I think Brookfields or whoever is the PE player, it's one of those B, I forget, either Brookfields, uh, Brookstone, Blackstone, whatever. So those guys are good. They know their business. So that's one positive part. So we'll have to keep it. You know, we'll have to keep and watch out. But again, there are much better quality real estate plays available in the markets than India Bulls. That's one. Second is I would much rather play the real estate theme through ancillaries. So plywood, sanitary ware, uh, tiles, paints, etc. are better, proxies to real estate than the actual real estate companies. Unless you find a really good company, which is not easy to get, especially for the long term. We might get opportunistic bets, like I think we did in hit picks with Colte. Uh, but that's not a stock that you would want to buy and hold for 2, 3 years, 5 years, because inherent problems with Indian real estate companies in terms of accounting, in terms of uh, how promoters manage those businesses. Okay. Next is question is from Sagar. A couple of questions. How do you see the tech sector, especially the global majors like Google, Amazon, Salesforce, etc.? Do you see any value in them emerging? Google, no. Amazon, no. Salesforce, or I don't track that much, so can't comment. But see, the challenge is that for both Google and Amazon, I think there's a lot of headwinds in terms of uh, their size, in terms of regulations across the world that is going to come in and is already coming in. Amazon, the primary play is AWS, so I mean, uh, the last 2 years, a lot of cloud migration has happened, but that's an incremental play. Valuations are reasonable, so Amazon probably is a better bet. Uh, Google, not too bad. In my opinion, US markets are going to take fairly long. I mean, it might take 2, 3 years for the US market to sort of stabilize and start moving up again, significantly. So, uh, one thing that I'm, sort of the thesis that I have in mind is Indian markets or emerging markets are going to outperform uh, US and developed markets by a long way over the next 10 years. I think similar to what we saw uh, in the decade of the 2000 to 2010, India and emerging markets outperformed. 2010 to 20, it was the other way around. Uh, okay, so that's about the global ones. I would also like to know, how do you see the tech sector in India? We've already spoken about tech. Next question from Mani Kumar. Are the stock recommendations in HitPix and stocks in Sri Vriddhi PMS are the same? They are not. The Sri Vriddhi is very close to what we do in Quiver. Uh, but there are slight differences in allocations, but more or less the stocks are similar. HitPix is completely different. Long term is completely different. Q10, Q30 are completely different. Okay. Then the next question are the advisory stocks different, same as the PMS? I think there's a fair amount of overlap, but there are small differences because of the timing of when we started off the PMS. But gradually over the next, say, 6 months or 1 year, we will have more alignment. There will always be some differences because in the advisory, the problem is I don't know how much money people are deploying. So I would always tend to go with more liquid names. Whereas in the PMS, because I control how we buy, when we buy, how staggered we can buy. We can get into companies where the fundamentals or the technicals are good, but the liquidity may be slightly an issue. Or the other thing is uh, getting in and getting out. So I can take some bets where conviction is slightly, not as much as I would like it to be. Just because that, I know I'll be able to pull the trigger if something goes wrong and I'll get out. Uh, I would typically not try to do that in the long term portfolio in the advisory because uh, again, I mean, I would want to have a very stable, good compounding kind of portfolio because there's a complete spectrum of investors investing, right? People who are from 22, 23 years old, just starting their career, to people who are retired. So the entire spectrum is there, and so you want more, decent, stable returns for the entire group. Okay, so question from Sogato: any opinion on new digital companies, Zomato, Nykaa? Do you see a possibility of some of these companies coming up as market leaders in their respective spaces in the long term? Absolutely. I think both Zomato and Nykaa are going to do extremely well. The question for at least these two companies that you've mentioned is not about their business model, but it's about the valuations. Uh, I'm a little bit skeptical about the business model of a Paytm or even maybe a PB Infotech or Policy Bazaar. But if I have to grade these companies, I think Zomato would be probably, in my opinion, one of the good businesses, followed by Nykaa, then PB Infotech, and then Paytm. I think is actually I, as of now the way what they're doing is I would be very skeptical of buying that company. So next question from Urmil to Hitesh Bhai. When you say finance, specifically private banks or NBFCs, microfinance, PSU banks as well? So Hitesh
I
Bhai,
answered, I
uh,
answered that on the chat box.
acha, okay.
It's better to create a basket
Acha,
than try to ride it.
okay. Good. Anurag, buy and hold IT, I think I've already answered. Uh, I think Zomato can be considered for next 5 to 10 years. It can be done. Two factors. Okay, so this is Hitesh Bhai. Okay, right. Nykaa Hitesh Bhai is not very bullish because he doesn't use makeup. But people who use a lot of makeup, I think Nykaa, they lot of people, lot of women do use Nykaa. I think what they've done is not very easy, and from a product perspective, I think they're doing well. How they roll it out, etc., is going to be difficult. Okay, Fluorochem. Fluorochem, I think, yeah, I mean, Fluorochem is a very interesting company. I think we've done. So yeah, disclosure. Both Hitesh Bhai and I both own Fluorochem. So both Hitesh Bhai is probably more bullish than me. I am also reasonably bullish. I think it's one of the. Let me put it this way. I mean, in terms of the way they are setting themselves up, uh, they are probably, I would say, today one of the top 3 or 4 chemical companies in India today, in my opinion. Okay, so if the levers that they are planning play out, it could actually do extremely well. Okay, so from Darshan, the question is: considering someone needs to deploy a large sum of money to take overall portfolio size bigger, how should one go about it? Deploy in one go or divide it into for 6 months to 1 year? Okay, so here, good question. See, the question is uh, the incremental money that you're going to put in, how much as of a percentage it is compared to your existing portfolio. So let's say you have your existing portfolio value is today 100 rupees and you want to put in another 100, then you can spread it out over the next 3-4 months. If it's another 1000, then maybe another 4-5 months. But in general, I would always suggest to stagger it between 1.5 months to 3 months. I think that is a reasonable time frame to stagger it. And in between, let's say you start putting in the money, if the market starts going down, you just hold on and stagger it a little bit more. So there's no formulaic approach, just played by the year. If you see things are, markets are just continuously going up, you deploy it faster. uh, that's the way to do it. Otherwise, just think in terms of between 2 to 3 months is a reasonable time frame to deploy. Okay. Okay, let's quickly go down. How many stocks do you generally, Hitesh bhai, question for you. How many stocks do you generally make a portfolio of? Do you have bifurcation of short-term, long-term bets? I can also answer the question for him, but I'll let him answer.
So basically, in my personal portfolio, I'm pretty concentrated. So I hold around 3 to 4 core bets amounting to around 50-60% of the portfolio. And in the satellite part, I play around with Technofunda thing. So there I got bets of almost 10-12% each. So maximum of 8 to 10 stocks, not more than that.
Okay. And the other interesting thing about Hitesh bhai is he concentrates very, very highly in stocks. So individual positions I've seen going up to 45-50%. Scares the shit out of me, but I doubt I'll be able to do that. But he's
That
able to do that.
scared the shit out of me also.
Okay. 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 Uh, okay. So I've taken this suggestion. I think a couple of you guys have put up about the monthly reviews. I'll definitely take a look at that and see if it is really going to be useful. Okay. Next question is from Rahil. How do you build position in stock once you recommend? Sometimes rally are so sharp and you just can't buy. Defense play usage in long-term portfolio was so sharp I missed it. And now it is up 30-40%. But if you jump in like GFL, you may see a sharp price correction. What's a good way to build on the recommended? Again, I mean, as I've always mentioned, right? You build it up over a period of say 1 month or 2 months, right? And what I typically tend to do, usually, if I am buying for my long term holding, I will typically buy 50% right away, and I will then keep adding uh, maybe on a weekly basis or on the days the market is a little bit down. I'll keep adding that. Over the years, last I think 2-3 years, I'm getting slightly better at timing. So you will see more of these problems that you've mentioned. I think the one that you mentioned about is solar industries. So you will see increasingly these kinds of problems because I will now try to, even in the long term bets, I'll try to, get, get in at a time when uh, where the timing is more conducive. I cannot guarantee that when we get in the next 7 days it will go up, but at least when it's when technically it is at a better chart structure compared to previously. What I used to do is good company, great company, good valuation, good growth, then just go and buy it. Now I am slowly incorporating a lot of technicals also. And 2023 I have sort of made up my mind that I will probably I'll spend a large part of my uh, you know my effort in building different quant and technical strategies. So hopefully we'll get slightly better at all this. Okay. Your view on Jubilant, Ingravia, and Axo Nobel, if you are tracking it. I follow both of them a little bit, not enough for me to comment. Hitesh, why you any views on any one of them?
Not much because chemicals, except for these very niche guys like say fluorochem, is unavoidable for me. Uh, ExxonMobil is an okayish kind of company. Their past track record hasn't been too great.
Yeah,
So better stick to say if you want to enter the same sector, then go with Asian Paints or Berger Paints, something like that.
correct. Next is Harsh. I joined long term picks a few days ago. How do I build positions? Is it advisable to buy stocks even last 2 to 3? Yeah, I mean, Harsh, I think I've mentioned, I keep mentioning this every time. A stock which is recommended 3 years back has nothing to do with how it is going to perform over the next 2 to 3 years. Way correctly to look at a portfolio is on the day. So today, what is it that you would want to buy if you had to look forward for the next 1 to 3 years? That is the way I look at a portfolio. So it has absolutely no relevance for me whether it was recommended 5 years back or 10 years back. So there are stocks that I've been holding for many years, right? The idea is so Bajaj Finance. I don't know. I mean, maybe I'm only holding for the last 10 years. The idea is even the next 3 years look good from even here. So that's the way. So recommended price and the recommended time has absolutely zero relevance in stocks which keep growing their earnings year on year. I got an IPO IPO allocation in LIC. This is Anurag, okay, which is in loss. Should you hold midterm? So why on earth would you even want to hold on to LIC? I don't know. Just book your losses, get out. At least that's what I would do. LIC is a good company. I mean, don't mistake me. LIC is a good company, good fundamentals. It will still be around next maybe 10, 15, 20, 30, 50 years. But the problem with LIC, in my opinion, is that it will continue to have a lot of supply from the government. The government has just diluted, I think, 3.5%. And so every rise, you will see that uh, the government coming and dumping stocks on you. So that is always going to be an overhang. Let's look at the chart. Okay, even the chart is getting better. So, but I doubt if you will get the IPO price anytime soon. Okay, Saji, earlier you had shared the Google spreadsheet for portfolio monitoring. Is it possible to share a Google sheet which you can add buys and sells so that you can monitor the growth of the portfolio like XIRR? Do you want to do it on a Google spreadsheet? It's too much of hard work. Just use value research or money control. A lot of these kinds. Or in fact, there's this other tool also which I used once, but I then stopped using. I forgot. Yes, this portfolio manager. I just keep updating that, and it will tell you your portfolio SIRR, CAGR, everything. I think value research portfolio does that. It's free. Just use that. Urmil, man, if Hitesh Bhai gets it right, he hits a jackpot. Yeah, I know that. And he gets a. The interesting part with Hitesh Bhai is he makes a lot of bad bets, but those are all small allocations, right? And all the big, 5x ones are at 30-40% allocation. So I'm not able to beat him in performance. Let's see. Next year I'll try again. Your view on Themis Med. What is it? I've never heard of this company. No clue. Jindal Steel has a good. Jindal, both Jindal Steel, Jindal Saw, Jindal Stainless, Hisar. All of these are interesting. Raj, any plan to rebalance the portfolio? Yes, I think I'll be making a few changes. One I can probably tell you now is I think we'll get out of Alchem, and most likely we will get back into PI Industries. So I think PI again has started. The commentary is improved. Things are looking better. So we'll get back into PI, and over the next 1-2 months we might get into some other interesting stocks as well. So we'll have to see. Okay. Stock scanner is recommended to identify possible breakout points. There's no stock scanner as such, but I personally use for technical this thing. I use Charting. I think Charting is reasonably good. I used to use Metastock before, but the problem with Metastock is the feed used to come in much later in the day. So Unil Market Smith, I have found I have not found it to be very good. Uh, Personally, I think it's easier if you do if you just follow some basic, basic. If you're looking at technicals, just write up some basic screeners on charting, or you can follow what we do on hit picks and else. In fact, I actually scan through 1,000 stocks pretty much every weekend. In fact, if you are able to see my screen, I don't know if you are able to see my screen, but uh, this is my my investing, and these are the like top 1,000 stocks that is there. So I just go through each one of them just to get a sense of what is going on, and I might actually think of sharing some of the interesting charts every week. I used to do that initially when we started off HitPix, but then a lot of people started saying, "What are we supposed to do with this?" and all that. So I thought, let's drop it. Let's not add to people's confusion. Okay, I think we are 1 hour 15 minutes. I think first 5-7 minutes we wasted, so more than an hour, and I don't see any more questions here. So we'll wait for one more minute and see if there are any questions coming in, or else. Okay, so there is one more question. How should we look at stocks having a significant part of their revenues in exports to USA and Europe over the next 1 to 3 years? It will be challenging. You will need to be very very specific in terms of understanding what the impact is going to be, how it is going to what is the product, how is the elasticity of demand, etc. Uh, but in general, my sense is US and Europe are going to be slightly weak for the next at least next 6 months to a year. After that, we will have to see how it goes. Okay, so many questions. Likely switch from Alchem to not VIPI. Okay, yeah. Your views on Elicon from a 3 years perspective. Elicon, if you've read the report that I had sent, I had marked that as a sort of an opportunistic bet. So these are not stocks where you have a 3 year view, right? These are stocks where you buy with a certain tailwind of the industry, of how the order is looking, order book is looking like, how execution is happening. 2-3 things go in your favor, you make a lot of money, and then you get out, right? These are not stocks where you will, if you hold for 3 years, it will come back to where you bought it from. Right? I mean, I cannot guarantee. Maybe next 3 years will be great, but you just keep following the news flow in terms of their results, etc. And you need to get out. See, the interesting part about businesses like Helicon, etc., or infrastructure, real estate, autos, these kinds of businesses is you need to get in and get out at the uh, at correct timings. Else, you will give up a large part of the gain, which is not the case for companies which are more compounding in nature. So, for example, uh, if you bought a stock like say Bajaj Finance or something like that, it keeps compounding over many years. Right? API Industries, a lot of these companies, they keep doing well. Once in a while, in between, they'll consolidate. If you're a really long-term investor, you can take that in your stride. Or what I try to do is I try to sort of jump from one to the other and then get back. Sometimes it is useful, sometimes it backfires. You'll never win all the games. You have to, sometimes like Argentina, you lose to a Saudi Arabia, but end of the day, you need to win the cup. That's the final thing. Okay, if mother market USA goes into recession, what happened? I that question. Next year, how you see its impact on India? I don't. In US recession, first of all, I doubt it will happen. Second is, even if it happens, it will be very short or shallow, and I don't see a major impact uh, in India. I think most of Indian uh, growth is going to come from the domestic market. Okay, Shogo, good. Is it a good time to move a part of quant to quiver, given that H1 FY24 may be short of momentum? It's a personal call. We don't know, right? Most of the time, I mean, quant also, if you've seen, we've also started making changes to the strategy to make it more aligned to how things are. But which one you should follow, whether quant or quiver or it takes or long term, is more determined by uh, your style of investing. That's one, and the reason why I have all these three or four things is for diversification, right? You want to do, you want to have style diversification. That to me is more important. When one thing doesn't work, the other thing works. That's more important. Okay, so Raj, should we stop SIP in Alchem and divert SIP to PI Industries? Yeah, you can do that. I mean, you can do that. I'll probably send it out sometime next week if I'm, able to update the PI report. You can go ahead and do that. Uh, how do you see logistics sector moving ahead? I think it has a good future. Problem is a lot of infrastructural bottlenecks, but in general, I'm pretty positive. Asahi, Canfin, Vinati have been down. Any views for mid to long term? I think I like all of them. Asahi, I'm pretty positive. Canfin should do well. Vinati also should do well. Will we hold on to all these stocks for the next 2 to 3 years or 6 months? I don't know. If we get better opportunities, we will move out and do something else. Your views on Axis Bank compared to ICICI and HDFC post merger? I think all these three banks will do extremely well. ICICI and Axis are my two favorite companies in terms of banks in private banking. Also, some of these mid-tier banks are looking interesting, but I would rather stick to the larger ones which have better risk management. What is your take on IDFC? I have no take. I completely dislike the bank, dislike the management. It will probably be the last bank I will buy in my long-term portfolio. Uh, Again, a request: can we have Quiver as an option in IntelSense other than small case? No. It means I'll have to do a lot of hard work, which I am not inclined to do right now. Uh, Okay, thank you very much. Thank you. So, yeah, I think it's nearing 10 in the evening, nearing the year end. So, we'll close for today. Thanks all of you for joining and spending time. And I'll close for today. And season's greetings and happy New Year to all of you. So let me stop the recording. How do I stop the
Happy New Year, Dada.
Happy New Year?
Happy New Year, everyone.